This is a real pleasure today, and I think you're all in for a great treat. But first and foremost, before I introduce Dr. Shilling, I would like to introduce one of the reasons he's here, and that's because for some strange reason he's developed a friendship with Mr. John Duffy, who, as you've all heard the name Duffy, whether you've lived there or whether you've been in the art building. John is a class of 1959. He has 2 children who graduated from here, president of the board for many years, and he's either the reason or the fault that I am here. John headed up the search committee in 1990 that brought Tom Sheehy and his family to Canterbury. So for that, John, we're forever grateful. Dr. Shilling comes to us from an amazing background in the world of economics. He's a graduate of Amherst College and then received his master's degree and doctorate in economics from Stanford University. He is the president of A. Gary Shilling and Company. He has been on numerous TV shows as a commentator on the economy. He has written a number of books, which I'm sure he'll refer to. Well respected on Wall Street and, in fact, throughout the world for his knowledge, his opinions, and his thoughts on the economy and what lies ahead. So it's a great honor, it's a great privilege, Dr. Shilling, to present you. Thank you.
Well, thank you very much. I am an economist. You know, I've got a reputation to live down to in this business. You know, economists are much maligned, and for good reason. You know, it's said that economists are people who don't have the personality to be accountants. And it's also said that economists were put on this earth to make weathermen look good. It's also said that economists are people who know how to make complex air out of simple truth. But my favorite story is an economist who was a noted professor, and he was a great speaker. He had just won the Nobel Prize in economics, and he was in so much demand on the speaking circuit that he had to hire a chauffeur to get him around to all his engagements. Well, on this particular occasion, he'd been invited to the White House for a command performance, and as they're rolling down the road to Washington, the chauffeur leans over the back seat and he says, "Boss, I bet I can tell you exactly what you're going to say today." And the great man said, "Really, what?" The chauffeur reels off 4 or 5 paragraphs, and the professor said, "You know, that's exactly what I had in mind. How did you know?" He said, "Boss, you give the same speech every time, word for word. I've got it memorized. I can give that speech." Professor says, "Really? What size suit you wear?" Chauffeur says, 42 long. "That's my size exactly. Pull over, we're changing clothes." So the chauffeur is in the back seat in the business suit. The professor's in the front seat in the chauffeur's uniform. They roll up to the White House, through the security check, into the East Room. The chauffeur gets up, gives the speech flawlessly. Professor's in the front row with the chauffeur's uniform taking a breather. Everything goes according to schedule until the speech ends, and the president stands up and he said, "Professor, that was a great speech. As a matter of fact, we hadn't counted on any questions, but it was so good I think we ought to take a few." Well, the chauffeur knew he was in trouble, and he knew it was in big trouble when a hand goes up in the back, and it's Ben Bernanke, the chairman of the Federal Reserve. And he said, "I only have one question." He said, "Given the problems we see in Egypt now, given the difficulties in the Eurozone, and the bustling economy in China, and the high unemployment rate in this country, I wonder if you can tell me your forecast, month by month, of the euro currency against the dollar for the next 24 months. Well, the chauffeur thought about that for a second, and then he said, "Chairman Bernanke, with all due respect to the immense job you're doing at the Federal Reserve and what you did before that as an academician at Princeton, I've got to tell you, sir, that's the most idiotic, asinine, ridiculous question I've ever had. It's so nonsensical, I'm going to have my chauffeur over here answer it." Well, what I'd like to today talk a little bit about is what economists do in the world. Some of you might one day want to be an economist. And I imagine that a number of you may very well major in economics when you get to college. Now, a lot of people today major in economics not because they're going to be professional economists, but as a general introduction to business. It's interesting, when John Duffy and I were in college, I think English was the most common major. I happened to be a physics major as an undergraduate, but English was the most common major in college then. I think now it is economics. And again, I think it's a general introduction to business, and you do learn some economics out of it, but whether you go on to be a professional economist or not is not the rule. But in any event, you might be interested in what we do. Now, there are a lot of different types of economists out there. There are some people who spend their life in the academic world. They become researchers, professors, usually a combination of both, in institutions of higher learning. There are also economists who end up working for the government one way or the other. The Department of Agriculture has a lot of economists worrying about various crops and estimations and gathering data and so on and so forth, which is very important to assessing the agricultural situation in this country and indeed on a global basis. We are in a global economy. There are other economists who work in private research operations, where they are massaging economic data, doing original studies and so on, overlapping with the academic world. There's some economists who are in government directly. The Federal Reserve Board, there's 7 members of the Federal Reserve Board. When it's at full strength, 5 of them have PhDs in economics. Matter of fact, they're trying to get some business people in there, some bankers, some people who understand more than just economics to get a better balance. And then there are people like me who are in the business of trying to forecast the economy and various financial and security markets on a global basis. Now, forecasting, one great sage once said, forecasting is difficult, particularly forecasting the future. And it is indeed difficult because you don't know what's going to happen out there. And you also, when you're looking at it as I am, where I'm very much involved in the financial markets, you're trying to figure out what's going to happen before the markets tell you. And markets are great anticipators. You know, the stock market is one of the best leading indicators of what's going to happen to the economy with a lead of roughly 6 months. In other words, you see something happen in the stock market, and it probably gives you an idea of what's going to happen in the economy a half a year later. But that's not exact. If it were, hey, everybody would know precisely, but it isn't, obviously, and that's what keeps you guessing in this business. But so what people like me are trying to do is to anticipate the anticipators. We're trying to figure out what's going to happen in advance, so we can say what the stock market will do, what the bond market will do, currency market, commodity markets, this whole range of various indicators that do relate one way or the other to the economy. But there are a lot of other things that are coming in there as well. I mean, what's been happening in recent years is there's a lot of what's called hot money. Money that is looking for advantages, money that is looking for arbitrage situations, looking for opportunities to make a lot of money in a hurry, and a lot of it tends to be leverage. Leverage means that it's got a huge amount of borrowing behind the equity involved. And this money is running around the world looking for opportunities. And for example, it's been was very much involved in the housing bubble, which collapsed, and I'm sure all of you are aware of that to one degree or another. It seems to be involved right now in commodities. We've had huge run-ups in agricultural commodities. We've had huge run-ups in industrial commodities like copper, lead, zinc, resins, various industrial commodities. And so there's all these things going on, and you're trying to sort these out and say, what can we see? How can we put this together? And how can we anticipate the anticipators? How can we get ahead of the game? Now, beyond that, in this business, there are various approaches to forecasting, and none of them work perfectly. And let me just say this, and I hope this, if there's one thing you remember out of this, you remember this. If anybody comes along and tells you that they have an exact formula to make money in stocks, you run the other way. There is no such thing. Now think about it for a minute. Suppose that John Duffy here, and John Duffy spent his career in Wall Street. He probably knows more about trading stocks than anybody else I know. But let's suppose that John Duffy had a formula that absolutely guaranteed to know what the Standard & Poor's 500 index was going to do a month from now. Suppose he had that. What would happen? What would happen? Well, first of all, he'd decide he was going to make a fortune out of that because he could with various instruments, this leverage, he could take a huge position with a relatively small amount of capital, small amount of equity, and make a huge fortune. But then John Duffy might be charitable enough that he'd tell me about it. And what would I do? I'd do the same thing. And I might tell the headmaster about it. So Canterbury would be a very wealthy institution overnight. Okay, we'd all be rich. We'd all be rich. But what would that do? What would that do to the applicability of the formula? Would the formula continue to work for very long? Probably not. Because soon we would become such an important part of the whole stock market that we would be changing the environment, the atmosphere around which John Duffy put together that formula. So it wouldn't work anymore. So any of these things are almost destined to failure. There was something a few years ago called long-term capital management. Anybody ever heard of long-term capital management? Okay. All right. This was exactly what that was all about. These were these guys who figured out how they could, with huge leverage, limited amount of equity, huge borrowing, take advantage of arbitrage situations, of nuances, of things that were pulled apart from market equilibrium that were going to come to equilibrium one way or the other, and they were going to get there before everybody else did and make a fortune. The only problem is that they were so big that they were the only game in town. They were the market. And when the music stopped, they basically collapsed. That's not all that uncommon. The same thing we've seen more recently with the housing bubble. That started off, like all these things, they start off very legitimately. In any speculation, in any bubble, there's always a grain of truth there. And in this case, it was the idea that Americans typically like to own their own houses. Wonderful. And it also was because since the 1930s, house prices nationwide have never gone down. They've always gone up. So everybody said, okay, let's get involved in this. This looks like a wonderful deal. So you had a lot of private lenders, mortgage brokers and so on who went out there and they said to people who couldn't afford chicken coops, we can put you in a 4-bedroom house. You don't have to put any money down. And by the time that it's necessary to refinance that house or to make a mortgage payment, let's say 6 months later, we're going to refinance that house because the price will have gone up and we can refinance it and you can actually pull money out, the appreciation that's taken place in the house in the meanwhile, and you'll be able to take out enough money that you can pay the mortgage payments and you don't worry, another 6 months later we'll refinance. This is what actually was happening. But again, this was a huge bubble and everybody believed in it and it kept expanding, and then they took all these mortgages and they put them together with other mortgages, they packaged them into what are called derivatives, and they sliced and diced that and sold that off to a lot of investors and rated this as very high grade investments, AAA, AA investments, and sold them off to everybody and said, hey, this is as good as an Exxon bond. It's rated AAA. And people didn't realize it was basically repackaged garbage. You know, it's a garbage in, garbage out kind of principle. Well, the whole thing ultimately collapsed. But again, this was built on the expectation that you simply can't miss that house prices always go up. So what I'm saying is when you look at these things and say anybody's got a forecast, just bear that in mind. Please don't believe there is any such thing as a sure thing. You know, that's the one mistake I think that people make, and they say, and it's made on a wide scale, and it's repackaged, and it always looks differently, but you always want to say, you know, the one thing, and let me just say this, the one thing that I believe that really contains everything there is worth knowing in economics is a very simple statement. There's no such thing as free lunch. There's no such thing as free lunch. Matter of fact, I want to have that engraved on my tombstone. Now, unfortunately, I won't be around to make sure it will be, and my wife is not of the same opinion, so it probably won't be. But the reason I say that, why do I say that that contains the essence of economics? Well, first of all, when you're talking about economics, you're talking about the allocation of scarce resources. You're talking about things that are limited, and therefore they have value. You know, when I was your age, when people talked about what is free, what is really out there that you don't have to pay for? Air. Clean air was assumed to be free. Now we know it isn't, right? It's very expensive. I mean, all the environmental cleanup, that's the price of having clean air. It's the cost of making it clean, keeping it clean to begin with. But if you do have anything that's really free, and maybe a glorious view of a Canterbury campus on a nice day is free. But anything that has any value comes within the purview of economics, because if it's scarce, it has a value. And the second point of this is, if it isn't, there's no such thing as free lunch. In other words, the lunch has some value, so it isn't free. Somebody has to work to produce it, and so on and so forth. And it really is talking about, in my view, the allocation of scarce resources, scarce in the sense that they have some value, that they're not free out there for the taking. So you're really trying to talk about how you allocate these. Well, let me go back to the idea of the role of the forecaster. There are a lot of ways of going about this, and again, I'm now talking about forecasting in a business sense, trying to forecast ultimately what happens to security markets, because that's where our business is concentrated. So now there are a lot of ways of doing this. Probably the most common way that forecasters do this is call up their friends. And they say, hey Joe, hey Sarah, hey Jane, what are you forecasting? How do you look at things? What do you think the consumer is going to do? What do you think we're going to do in terms of meeting President Obama's goal of doubling our exports in 5 years? How about the housing situation, when that's going to turn around? And you talk to all your buddies in the trade, and they say, okay, here's what I think. And you say, yeah, I kind of had the same idea. So you come up basically with a consensus forecast. Now the problem with that from my perspective, and you're listening to Gary Shilling, I'm not talking for the profession, you're just listening to me, and this is my personal view. The problem with that is you very well can brainwash yourself, because I talked to Joe, and Joe talked to Jane, and Jane talked to Sarah, and Sarah talked to Henry, and Henry talked to Joe, and Joe talked to me. So I may be hearing myself coming all the way around. That may not be an original forecast. And the other aspect of this is, and again, this is me talking, the consensus view is discounted by the markets. Discounted means that it's fully appreciated by the markets, that whatever is the broad view is already built into the markets. I mean, you can see this on an individual stock basis. I mean, for example, let's say that IBM announces their earnings, and the earnings are higher than the analyst's estimate was. The stock goes up, usually, because the analysts did not anticipate as good earnings as IBM came up with. That's the same kind of principle. I'm talking about this on a broader basis in terms of economic aggregates. But the point is, the consensus view is, I think, usually already worked into the markets. It doesn't add any value. And in my view, as a matter of fact, in any business, and any of you go on into business one way or the other, you'll learn this sooner or later, that value added must exceed costs. Value added must exceed costs. If somebody makes an investment, the value added, the amount that is going to add in terms of their profits, must exceed the cost. Somebody goes to work for somebody else as an employee. The value added, what you add to the enterprise, what you ultimately add to the reputation, to the profitability, however you want to measure it, must exceed the cost of hiring you or me or anybody else. So my view is that to add value in what I do, I've got to look beyond the consensus. I've got to find out what's new, rare, strange, and exotic out there. What is there that is not fully discounted in the markets? And so that's what I do. I try to look for things that, first of all, are important. It can't be trivial. I mean, you look at a lot of economic statistics that are reported on a monthly basis, and guess what? A month later, you got a new set of statistics, and you probably revise the old statistics to the point that they're now meaningless. So that is, it's got to be important. Secondly, you want something that has a good chance of happening. You know, there are people in this world who are what they call contrarians. A contrarian is somebody who always takes the other side of a position regardless. In other words, you walk out and you say, gee, I think it's a beautiful beautiful yellow moon out there, and the contrarian say, you sure it isn't yellow? You sure it isn't pink? You sure it isn't orange? A contrarian always takes the other side of things. I'm not a contrarian because I think ultimately in my business I'm judged by what my track record, how correct I am in the forecast. So you don't just take an oddball position for the sake of notoriety. So you want to pick things that are important, you want to pick things that have a good chance of happening, and you also, in my view, you want to concentrate on things that the consensus, that the vast majority of competing forecasters don't see or don't yet see. You hope they eventually do see, because you hope they actually happen. And those are the things that I concentrate on. And I've always been guided by two very fundamental principles. One is this one I just articulated, that that what you're trying to do is to find out what is important, likely to happen, and not within the consensus purview, where you can add value. And the other principle, quite frankly, is very simple. I don't think human nature changes very rapidly over time, if at all. And if that's true, that means that people will react to similar circumstances in similar ways. In other words, history is relevant. If you can find a set of circumstances historically that looks reasonably like what's going on today, and then you can say, what happened back then? How did things play out? What did people do? What was their reaction? Then I think you may have an opportunity, you may have a chance of forecasting what's going on now. Now, things are never quite the same, and you always have the problem of picking the right piece of history. Mark Twain said, history doesn't repeat, but it rhymes. And I think that's probably true, that there is a similarity. Well, this business is, as I say, it's an interesting business. It's one that I find exciting. I've been at it long enough. If it isn't, I don't know why I'm spending my time at it. But it's always very challenging because the situation changes. And unlike an academic position, and I must say this is what I learned when I started working years ago. I started working for what was then Standard Oil, New Jersey, now ExxonMobil in Manhattan. And I was coming out of an academic program where you take a piece of data, you know, you're writing a PhD dissertation or whatever, and you're looking at it from all angles, and you're kind of saying, you know, let's get a line on this and let's see which way this thing shapes up. And you get out in the business world, and whether you're trying to forecast the economy or run a business or do whatever it is in the business world, it's constantly changing. The minute you get a sight on that animal, that beast has moved. It's never the same. It's always changing, and that's the exciting aspect. But it also is a frustrating aspect until you get used to it when you're coming out of an academic academic program. Well, I don't want to spend all my time talking. I want to allow plenty of time for questions. Let me just open this up, and let me just say that there are no dumb questions in this business. Because if I really knew all the answers, again, I'd be back with John Duffy's model. I wouldn't need to work for a living. I would have made so much money I wouldn't need to bother. So there are no dumb questions, so please Go ahead. Who's got a first question or comment? Yes, sir.
The history you compare it to make a guess.
I'm sorry?
When you look back in history to make a comparison on it, like what would be an example of that? Sort of like how
Looking backwards? Yeah, sure. I'll give you a very concrete example. This goes back to the early 1970s. This was a time when inflation was raging in this country, quite the opposite of where we are today. And there was a feeling in the early 70s that we were running out of almost everything, whether it was agricultural commodities, steel, cement, iron ore, copper, whatever. There was a feeling that we had shortages forever in the world. And as a result, people were convinced that inflation was running in double digits. We had inflation rates of 10, 12% per year, and people thought that this was going to continue 15, 20% and so on, because we just had shortages of everything. Well, we did some work on this, and we looked at the steel industry. And the steel industry, it's kind of an interesting industry because even more so at that time than today, there was a middleman in the steel industry called warehouses. Steel service centers, they're called as well. And they basically buy steel from the big producers, U.S. Steel, Bethlehem at that point, and they do some fabrication and so on, and then they sell it to smaller steel users, people building bridges or machinery or whatever. And because of this, the data at that time, it wasn't clear where the inventories were in the steel industry. And we did some work on the steel industry, and we looked at the amount of steel that was being produced on this end, and then we stepped over here and said, how many cars, how many appliances, how much machinery is being produced? And the two didn't match up. There was a lot more steel being produced than you could account for by the number of cars and the other big steel using industries activity. And we knew, so we figured out there were a lot of inventories that weren't being reported because the steel industry reported their inventory levels. In other words, because everything you produce, if you don't sell it, it goes into inventory. It goes into stockpiles. And we didn't see it there. We didn't see it on the user end. So we figured it was these middlemen that were hoarding this steel in effect. And they didn't report their inventories. And it was very logical that they were hoarding steel because everybody thought there were going to be shortages, the prices were going to keep going up, so why not hold this? You make a lot of money. You know, buy the steel at $100 a ton, and next year it's going to be $150 a ton. You make a lot of money out of this. So we figured this out. And then we looked at that more broadly, and we said, maybe that's what's going on in this economy. Maybe this isn't shortages forever. Maybe it's just massive inventory building. Okay. The next step of this goes back to when I was at Stanford, and I spent a summer working at the Federal Reserve Bank of San Francisco. And while I was there, I would browse through the library, and I saw a book, and the title was The Inventory Cycle, Hand-to-Mouth Buying. Hand-to-mouth buying, and that was an intriguing title in an economics library. So I pulled that book out and I looked at it, and it described, and this was back, you know, this was some 20 years earlier, it described what had happened right after World War I. After World War I, there was a huge catch-up economic activity in this country. They converted from wartime production, you know, guns, tanks, etc., to, and you got tanks sitting down here in the town green we just saw from World War I. Okay, they shifted from that, they shifted to civilian goods, and there was a lot of catch-up demand. And there was a huge inventory cycle that built up as a result of that, because prices were going up. Prices went up much more than they did in this country in the 70s. Wholesale prices went up 50% in 6 months. I mean, it was a huge inflation. People were taking they had parades down Fifth Avenue in New York of people who were pledging to buy only the necessities of life until prices came down. It was very, very strained period. But there was huge inventory building. And this book described how all these shortages developed. And I looked at this and I said, my golly, that's a carbon copy of what we're seeing now. And then I turned the page to see what happened. And all of a sudden, all those inventories, people were double and triple ordering because they wanted to make sure they were going to get enough. And all those inventories arrived. And then the whole thing collapsed. And because there was so much excess inventory, nobody needed to buy anything else. Production went down. And what happened was the 1920-21 recession, which was the sharpest recession on record. In other words, the decline in economic activity was the fastest. It wasn't the biggest peak to trough, but in terms of the rate of decline, it's the sharpest on record, 1920-21. And I looked at that and I said, you know, that looks like what we're going through at the time. So we came out with a forecast in early 1973, and this is before the oil embargo, which is in October that year. And we said, hey, we think this is not shortages forever, this is a massive inventory cycle. Well, that's exactly what it turned out to be. And the 1973-75 recession, until the most recent one, was the biggest recession, the deepest recession since the 1930s, and it was massive inventory liquidation. In other words, people weren't buying any more goods because they had a whole stockpile to work down before they ordered anything new. So that was a clear case of finding a piece of history which was indeed relevant to what was going on at the time. And it really, you know, it's like a lot of things. They're chance things. It just happened. I was wandering through that life. Oh, and by the way, hand-to-mouth buying. Why the title of the book? The title of the book was because after that, people were only buying hand-to-mouth. In other words, they would buy only as they needed the goods. They wouldn't buy anything to stockpile because they were so scared, and that's how the title of the book. But that was just a chance occurrence that I'd happened to see that book, happened to read it, and found it relevant some 20 years later. Long explanation. I'll try to make the answer shorter than the next question. Yes, sir?
Can you talk a little bit about regulation? Like, do you think the current administration's policies are too aggressive, or are they necessary? Like, what do you think about that?
I'm sorry, can you?
Can you talk about regulation?
Yeah.
Do you think the current administration's too aggressive, or do you think it's a necessary thing?
Yeah, well, you know, regulation is in the eyes of the beholder. And there are people who feel that we don't have enough regulation, that, and they say, hey, proof positive. Look what happened in the last 3 or 4 years. If we'd had more regulation, or if they'd enforced the regulations that were on the books, we wouldn't have had the big housing bubble. If there had been more regulation at Wall Street, you wouldn't have had these huge leverage plays, and that's what it was. Leverage in the sense, again, a little bit of equity, a lot of borrowing. I mean, for example, firms like Bear Stearns, you ever heard of Bear Stearns? They don't exist anymore, right? Lehman Brothers, they don't exist anymore. They went from 20 times leverage, in other words, they were borrowing 20 times their capital, to 40 times. Okay, and some people say, hey, if we'd had more regulation, then that would have not have occurred. We wouldn't have had this huge mess. Now, on the other side, there are people who say we have too much regulation. And we are getting a lot more regulation, which is way too much, in response to the financial problems. And the one thing you can always be sure of, if you look back in history, is that every time you have a big financial crisis, you will get more government involvement. You'll get more government involvement. Government always gets involved in reaction to big national traumas. The last century was one of tremendous growth in government involvement in all aspects of life, the economy and so on, here and around the world. Well, why was that? What were the 3 big events of the last century that got the government involved? What? Sing out. What were the 3 big events? I'm sorry, I can't hear you. 2 world wars and the Depression, right? And they got tremendous, you know, the reaction. I mean, that's the way, the kind of world we live in, and that's what happens here. So there are many people, and you can divide these, you know, the Democrats, Republicans, Tea Party versus liberals, however you want it. But people look on regulation in different ways. I mean, I happen to be on the side where I think that the danger is excessive government regulation, and it probably was more a matter that they did not apply the regulation that was on the books. But the attitude back in the housing bubble days, the attitude of the Federal Reserve, the attitude of the Republicans then running in the White House and so on, was that the markets will discipline anybody who steps out of line. In other words, if they want to go out and be a damn fool and leverage themselves up and they go bust, well, okay, you know, we'll all go to the funeral, but they're tough luck. All right. But then there were a couple of other things that came in that complicated this. You ever heard of too big to fail? Yeah. Okay, too big to fail. What's that mean?
The banks were too, just when the investment and commercial bankings combined, they were just too big to fail. I don't know how to explain it.
Well, they were so big that if they did fail, that they would do irreparable damage to the economic system, to the whole structure of the financial system. So that really came in. So even if they had adhered to this doctrine and say, okay, let them fail, you know, they're tough luck. Then they came into the problem with too big to fail. So this complicated the issue. So it isn't. I don't think it's a question of whether you have regulation or not. It's a question of how intelligent is the regulation, and to what degree does the regulation interfere with the legitimate role of commerce. You know this guy, you ever heard of a guy named Michael Lewis? Okay. He's written, okay, what did he write? What was his most recent book?
Oh, The Big Short.
The Big Short?
Yeah.
Okay. He wrote one called Liar's Poker years ago, talking about a Wall Street firm, Salomon Brothers. And, but anyway, very bright guy. I heard him excuse me, interviewed on TV, and he made what I thought was a very profound statement. He said the financial structure is a parasite on the economy. He said it's a very necessary parasite, but it's a parasite. Now, here's what I think he meant. He didn't explain it, but here's my interpretation. What he meant is you need a financial sector to grease the wheels of the economy. If we didn't have a financial sector, we'd be back to a barter economy. And that wouldn't really work too well, would it? You know, where you've got to produce apples to go out and trade for a suit of clothes, and if you've got a failure in your apple crop, well, no clothes that year. I mean, it's not a very efficient economy by any stretch of imagination. So you need a financial sector. But his point is, so it is in effect, and the financial sector exists in order to make the economy run. And in that sense, it's a parasite. Without the basic economy, you wouldn't need a financial sector. But what he's also implying, I think, in that is that the financial sector went beyond that role. And I think the financial sector, many of the players, felt that they were it. And the rest of the world didn't make any difference. And they were off with these derivatives in cyberspace and creating, you know, derivatives based on derivatives based on derivatives. And a lot of these guys couldn't care less. They were putting these things together, selling them off, forgetting about them. Whether it was garbage, ultimately, that was being sold, didn't make any difference to them. And I think those were the kinds of extremes that were there. And you say, well, maybe when you combine that with too big to fail, you do need some degree of regulation. But as I say, the risk is after you get a big trauma that it gets overdone. And I think that was a phase we were in until the first Tuesday in November last year, which what happened? First Tuesday in November? What happened? Yeah, an election, right? And what happened in that election? The Republicans took over the House of Representatives. The Tea Party people, who are very much on the right, don't believe in much government at all, gained power. And so we've seen a shift in the administration. I mean, here's a president who said, we're going to get you fat cats on Wall Street, and now he invites them into the invites them into the White House for a chat and say, how can we work together? There's been a change of attitude there. And that's what politicians do. They read the tea leaves, they read the election returns. And so it looks now like maybe the regulation isn't going to be quite as intense as it was, but it's probably still going to be fairly intense in reaction to the, all the trauma. Yes?
When industries like the housing market, they crash, does the government need to regulate it to get it back up, or can they do that by themselves?
Yeah, the housing. Does the government need to regulate the housing industry to revive it? Housing is a very politically important sector in this economy. You know, the American dream of owning your own home, usually a single-family house, but maybe a condo, or in New York, a co-op. That's a very powerful very powerful political force in this country. And as a result, government has been very, very favorably disposed toward housing in this country. And as a matter of fact, a lot of these people that I mentioned earlier who really were buying houses with literally zero down, in some cases negative equity, because they got two loans. They got a mortgage loan and then what they call a piggyback loan, which was on top of that. That was for home improvements. So they might have borrowed 110% of the value of the house. The house was worth $100,000. They borrowed $90,000 on a mortgage and another $20,000 on a home improvement loan. So they actually borrowed more than the value of the house. So government was very favorably disposed to this, and in the name of improving home ownership, they fostered very low down payment, and as I say, some cases negative down payment loans, because the reasoning was, and this goes back, this actually started with President Clinton and then was carried on by George W. Bush. The idea was we want to get home ownership for low-income people, for minority people, for younger people. The idea is if people own their houses, they've got a vested interest in their community. It's going to be more stable families, more stable communities, and so on. Who can argue with that? But the only problem is they say they got a lot of people in the houses where there was no way they could afford those houses, and they could only make the mortgage payments if they could constantly refinance, because the price went up and they could refinance them, take money out as a result of that. And does everybody understand what I'm talking about there when you say refinance? In other words, let's say you've got a house that's worth $100,000. You got a mortgage of $90,000 on it. You don't have the income to make the mortgage payment. But if the house next year is worth 10% more, it's worth $110,000, then you refinance it and you take a mortgage to $100,000, and you basically get $10,000 cash out of the deal because you're increasing the mortgage because the value of the house is going up. And that allows you to make the mortgage payments out of that $10,000 you take out on this so-called cash out refinancing. Well, the point is that this kind of thing was going on, and in the name of home ownership, it created tremendous imbalances, which only would have worked if house prices had continued to increase. The result we're facing now is a huge excess inventory of houses. We estimate that there are over 2 million housing units out there, single-family houses and apartments, 2 million over and above the normal level of inventories needed to take care of selling new and existing housing. Now, 2 million excess inventories is a lot, because on average, long-term in this country, we build about 1.5 million a year. And to have over 1 year's excess, that's a tremendous amount. And our estimate is that what's happening right now, it'll take at least 5 years to get rid of, to absorb those excess houses. And that's assuming that markets continue to function. Now you say, well, what can government do? Well, not much in these circumstances. Not much. Because if they do what they were doing before, which is to make housing affordable to people who really can't afford it, then you recreate the problem you had before of people who are simply there. I mean, there are a lot of people in this country who really ought to be renters. They can't afford otherwise. And as a matter of fact, with house pricings declining, there are a number of people who are now saying, hey, why should I own a house if it's declining in price? And we think there's probably another 20% decline in house prices because of these excess inventories. Excess inventories are the mortal enemy of prices. The way you get rid of excess inventories, you cut prices. And as I say, increasingly people are saying, and we happen to think that's a great investment area, rental apartments, because people are saying, hey, why should I, you know, younger family says, let's wait till the kids are really old enough that we need a single family house, as opposed to earlier they wanted to get one as quick as they could because it was a very appreciating asset. It was a great investment. An empty nester, some guy says, you know, I don't like to mow the lawn. Let's get out of this suburban money pit and move not into a co-op or condo, but they move into a rental apartment and invest elsewhere. So I think you are seeing changes in result of this, but there's not much the government can do. As a matter of fact, the government just yesterday, Friday, released a blueprint of a plan to try to deal with the housing situation in two bodies, Fannie Mae and Freddie Mac. I don't know if you ever heard of them, but they basically are saying that they would like to disengage the government from as much sponsorship and involvement in the housing sector and turn it more over into the private sector, require higher down payments, make sure that when people get in houses that they can't afford them. Yes, sir.
What would be your opinion on getting out of the national debt?
I'm sorry?
How would you decrease the national debt if it was in your hands?
Say it again, I'm
If it
sorry.
was in your hands to decrease the national debt, how would you do it?
How you decrease the national debt?
Yeah.
Well, the best way to do that, I think everybody would agree, is to increase the level of economic activity. I don't think many people think that the debt will actually decline. Now, it did decline for a brief period, about 3 years back during the Clinton administration, when the government was running a surplus. In other words, if you run a surplus, then you will pay off the debt. And for a brief period, there were some people actually worried about paying off all the debt. Because if you paid off the debt, it would be very hard to operate the monetary system. The Federal Reserve basically operates by using Treasury obligations, Treasury bills, bonds, and so on. But that was a very brief period. But now the question is obviously the opposite. But to run a surplus, to pay down the debt, you need a very strong economy, stronger than I think most people expect, certainly stronger than I expect. So the most logical way is not to reduce the debt, but to increase the size of the economy through growth so that the debt in relation to the economy, GDP, is smaller. And that would do marvels. That would do marvels for the debt. In other words, if you the debt is now about 60% of GDP. If you double GDP, it'd be 30%. It's that kind of thing. And by the way, if I can, just one more thing. I wrote a book recently. It's called The Age of Deleveraging, Investment Strategies for a Decade of Slow Growth and Deflation. So you know where I stand. And I'd like to give a copy of this book to the person who can give us the most correct number on where GDP is. Does everybody know what GDP is? The sum of all goods and services produced in the economy. And I'm going to give this book to whoever gets the closest number to what it was in the fourth quarter. Now, we got chalk here and write down number. Well, yeah, okay. Is this okay? All right, okay. Now, I don't expect anybody to know the number, but you know, this is a lottery in effect. Throw out some numbers. Let me just say it's in the trillions of dollars, so we'll start with the trillions.
13 trillion.
Pardon me? 13. 1320? 25. Okay. All right, everybody? We got everybody? 9.7. By the way, before I announce the winner, I'll just say that when young economists come to work for us, they don't know any more than you do. And I don't expect them to. And by the way, levels, in economics, levels of numbers are very seldom of any value anyway. You want to know change. You want to know growth. How much different was it one quarter to the next? Now, here's the number in the fourth quarter. So, I think that's our winner.
Way to look it up, Joe.
Congratulations. The book is yours. And I'll inscribe it for you.
Thank you. Great job.